Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. We've been talking a little bit about some of the mass media, some of the stories they put out, and how, number one, it's very inconsistent, and number two, it can actually harm your financial future. We talked a little bit about the press release of Lowe's earnings. This was just so classic. If you missed it, please go over to the website, dlblain.com. Look for the archives of today's show and listen to it, because we talk about how two of our premier agencies, the Associated Press and Reuters, reporting on the exact same story, and how you get two totally different pictures of how Lowe's did in the third quarter. The one, very pessimistic, talking about profits sinking. The other, talking about how they topped the estimates and are raising their estimates for the next quarter. It's just a great, instructive story about how the media can present the same information in two completely different, diverse ways. Then we started talking a little bit about why CNBC won't make you rich. A lot of it has to do with behavioral finance. We talked about how investors in the third quarter withdrew a net of, what was the number, $53.5 billion. That was year to date. They withdrew $53.5 billion. Warren Buffett, on the other hand, our shining example of investing for the long term, invested $23.9 billion in the third quarter alone. And he believes, as we do, that strong rising earnings, low stock valuations, and exceptionally low interest rates actually present probably one of the best stock buying opportunities that we've seen in several years. Now, this does not mean next month. You know, I don't know that stocks are going to go up next month, probably not even next year with the election looming. The election years are typically not that great for the stock markets. You've got all the problems over in Europe, things going on there. But unless you think the whole world is going to collapse, this will probably look back as one of the better times to be acquiring stocks. That if you look at the way money has been made in the markets, it goes in fits and spurts, that you have decades, 10, 15, even up to 20 years where markets don't make any money. This is true both in the U.S. as well as overseas. In fact, overseas, we see markets actually go out of business. I was reading a study the other day that somebody went back to 1900, and I think in 1900 there was around 25 or 26 stock markets in existence, and then they went to today, and there was only 3 that actually made money over that time period. And I should have bring the study in. I'll try to remember to cover this in another show. But the U.S. was one, Australia was another, and I think South Africa and maybe the U.K. were the other ones. But only a slim percentage of the markets had made money. In fact, a large percent of them had actually gone out of business in the interim. Japan, obviously, their stock market went away. World War II, Germany, the stock market went away, and a number of other countries. So there is the risk that stock markets actually go away. The United States is one of the longest running stock markets that we know of. Certainly for this study, one of the best performers. That probably to assume and extrapolate that will continue on into the future indefinitely, that would be a very poor decision to make. But to assume that the concept of companies earning a profit, I think will always be here. And so if we look back, if we go into the future and look back, today will probably be one of those times where it would have been very fortuitous to accumulate some equity exposure. Even as countries possibly collapse or stock markets go out of business, we see today's economy is much, much more global. And you have companies, for example, like Coca-Cola, that is headquartered in the United States. If the U.S. stock market, were to collapse and go out of business, would, the value of Coca-Cola, evaporate? Well, no, the people still would own shares of Coca-Cola. And the company would still be in existence producing Coke. They earn the majority of their revenues overseas anyway. And so it would be very interesting to see what happens today if we have something like World War II or World War I, where you had entire countries just sort of, their economies cease to exist. It would be fascinating to see what would happen. Well, I hope that it doesn't happen, but I think you would see a very different result than happened historically, that some of these global multinational companies would still have some value to be had, and that their stocks would be traded on some sort of exchange somewhere, even if it was not in their home country. Well, we've got about a couple minutes left. I want to say this is a big topic about behavioral finance, and why watching the news and reading the Wall Street Journal and these type of things are not going to make you rich. As I mentioned previously, Wall Street Journal does have some good journalists that work for them that have some good, solid financial advice, but for the most part, the day-to-day gyrations of the market are unimportant to an investor with any sort of long time horizon. It fascinates me when people talk about, you know, these one-day moves in the market, or even this multi-period move, that it's expected in history, and anyone that has studied history of markets knows that there are periods of time where the markets are just sort of treading water. The challenge is you don't know when they're going to stop treading water and take off and make, you know, 200, 300, 400%. But that's the way money is typically made in equity markets. You have these time periods where there's sort of this economic malaise. In the past, it's been inflation, interest rates. This time, we see interest rates very low, inflation very low, but the global economy just can't get itself going. And so you don't see the price of stocks. You see them go up and then go down and up and down, but the net is sort of, you know, hasn't gone anywhere. One of the reasons why it's important when you look at a total return basis, including dividends, is something we talked about last week, is making sure that when you're looking at the return of markets, that you're looking at, or you understand what you're looking at. Are you looking at just a price return or a total return, which includes dividends? Including dividends, that's where your return comes in these time periods where markets really don't go anywhere. The dividends are a nice buffer, so that at least you're making, you know, 2, 3, 4, 5%. Well, that's about all the time we have for today. A little bit of a teaser for next week. We're going to be talking a little bit more about this behavioral finance. So for All Things Money, I'm your host, David Blain. We hope that you will join us again next week at the same time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.